Welcome to CRE Fast 5. I'm Carly Iacono, and tonight we are talking about mergers and acquisitions in the retail space. Let's jump in. The total value of U.S. retail deals transacted in 2020 in terms of mergers and acquisitions was roughly $36 billion, nearly triple the $13.9 billion tallied in 2019. That growth came after year-over-year declines in both 2018 and 2019, according to corporate law firm White & Case, which compiled the data in partnership with the M&A insight tool Merger Market. Note that a deal is still considered an acquisition no matter the sort of business a company is purchasing, a healthy one or one out of bankruptcy, which could explain some of the increase in activity. For 2021, corporate executives are optimistic about M&A activity, with 53% of U.S. CEOs in a recent PwC survey stating that their companies plan to increase M&A activity in the coming year. Despite the economic challenges faced in 2020, there are many factors such as low interest rates and significant amounts of corporate cash reserves and private equity capital that are putting certain strategic buyers and private equity players in a strong position to engage in deal making. Now let's run through 5 themes likely to drive M&A activity in 2021 and beyond. Number 1, sound fundamentals will support activity. Economists predict GDP will rise 4.2% this year. Interest rates, as you know, remain historically low at less than 0.25%, and the Dow Jones crested to record highs at the end of 2020. These 3 economic factors will set the stage for deal making. Number 2, COVID brought lasting change, and M&A will help companies adjust. The pandemic highlighted how crucial technology has become for delivery, engaging with customers, and supply chain management. So more companies are likely going to have to turn to M&A to strengthen their digital infrastructure and tech capabilities. Number 3, private equity companies and SPACs, special purpose acquisition companies, are going to have to deploy capital. PE firms are sitting on more than $1.7 trillion of dry powder, and SPACs have raised more than $60 billion in 2020, according to DealLogic. So with these companies, they have a limited amount of time that they have to put out the capital that they've raised, so they're going to be focused on transacting after a slow year for deal flow over the past 12 months. Number 4, stability will reinvigorate the middle market. Middle market firms have proved difficult to value in 2020 amidst the high levels of uncertainty and market volatility, but the mass vaccination campaigns now underway in the US and around the world, as well as a clear election result in November 2020, should help clear the uncertainty from the market that's been plaguing the M&A deals that were somewhat underway, and have the mid-market firms return to focus. Number 5, a Biden tax increase could nudge more deals to market. Biden's tax plan calls for an increase in capital gains tax for high earners from 23.8% to 39.6%. So tax issues are rarely the primary catalyst for deals, but those already contemplating deals could be incentivized to strike before that change comes into effect. These are some of the reasons I expect increased activity in 2021. Now let's run through some of the notable retail deals in 2020. There were some big ones. Number 1, 7-Eleven acquired Speedway for $21 billion in cash. Crazy. They had 3,900 stores that were acquired in 35 states, and the effects of this merger and how it will impact 7-Eleven's expansion and development model long-term has yet to be fully seen. Number 2, Brookfield Property Group and Simon Property Group acquired JCPenney for $1.7 billion. Interestingly, as part of the agreement, the parties could create a separate real estate investment trust and property holding company that would include 161 of Penny's real estate assets, along with all of its wholly owned distribution centers. There's a lot of speculation on the theories behind this strategy, and it'll be interesting to see what happens with JCPenney's bricks and mortar locations long term. Number 3, Inspire Brands acquired Dunkin' Donuts for $11.3 billion. Inspire is backed by Brook Capital and operates more than 11,000 restaurants. Following the completion of the transaction, Dunkin' and Baskin-Robbins will be operated as distinct brands within Inspire. So no more of those brand within a brand, single tenant concept that you've seen where they both partner in one location. Number 4, Home Depot acquired HD Supply Holdings for $8 billion. So HD Supplies was sold about 13 years ago, and now Home Depot is repurchasing it in what appears to be a move to better control their supply chain. Number 5, Yum acquired Habit Restaurants for $375 million. Habit operates 300 restaurants across 13 states. Number 6, Winn-Dixie expanded via the acquisition of Lucky's Market with stores across Florida. Number 7, Pet Supplies Plus is extending its reach by buying 40 stores from a failed competitor, Pet Value. This is just the tip of the iceberg. I expect increased M&A activity in 2021 in the retail sector in particular, and we'll keep you updated as new deals are announced. That was CBRE Fast 5. I'm Carly Iacono. I look forward to seeing you again soon.